I'm personally also an angel investor aside from my day job. I probably made already like close to 30 or maybe 40 investments. I would suggest do not do due diligence. I mean, this is controversial, but it's just a waste of time. I like the founder, I like the business, I write a check.
Welcome back, everyone. Super excited to have you here. I'm Lucas Poles, the managing partner of Pegasus Angel Accelerator, for another episode of VC Unfiltered. Today, we're taking you behind the scenes of an event that Tech Coast Angels, one of the largest angel networks, threw here a couple weeks ago. We've got a bunch of a great panel of venture capitalists that came and gave unfiltered advice to some of the investors. And so, take a listen.
Hi, my name is Sanjeev Zhao. I run River Guide Labs, AI background, then went out to start a few companies, was a hired CEO, and now I run an investment firm called River Guide Labs. We do very sector agnostic, not just tech, but infrastructure, things like that, all across the world. I also organize events. I think somebody in the first panel talked about organizing events. I also organize events as well, where we invite experts to talk about subject matter expertise. And so really looking forward to this panel here.
Hey guys, my name is Yipeng Zhao. I'm a partner at Embark Ventures. We're a local boutique firm focused on deep tech investing. We manage about $100 million under two main funds and another close to $100 million under other side vehicles. So been investing in deep tech and AI for almost 10 years. I was working with another firm before and being in the private investing for quite a bit. So happy to share some of my observations, I guess.
We all know, and this is the analogy I heard recently, data is the new oil. So since that's the oil is what makes a lot of country a lot of money, and I'm a straight shooter, I go straight to the tough question. How do we make money in deep tech and AI? How are you evaluating literally how you monetize it?
Good question. I'm not going to tell you how to make money because secret sauce for us.
That's what we want.
No, I'm just kidding. So I guess it's a hard question. Deep tech investing has been a pretty new thing for the last few years, right? So I would say, to really make money here, it's basically the same thing as other tech investing, right? 'Cause deep tech is just a subsector of tech, right? So the fundamentals are very similar with other tech business, right? So aim for growth, right? You have to be growth-driven versus quote-unquote revenue-driven, right? So all the other lessons we learned, years of investing tech, decades of tech investing, still sort of true for deep tech investing, right? So although I would disagree on data is key in this era, so investing in data companies will not make you money for sure, right? So that's one thing we learned, and there's a lot of pitfalls in the space, right? So I would say I don't think anybody have a good answer on how to make money, but I sure know how to not invest, right? So I would say I know a lot of things we shouldn't do, but I just have to be honest, nobody knows the answer of how to make money in deep tech yet.
Can you go ahead and elaborate what shouldn't we do?
Yeah, it's a lot of things we shouldn't do, right? Like for example, chasing the hype is one thing, for sure to lose money, right? So we all been through the bubble times, multiple times, right? So chasing the bubble and buy high sell low is always a way to lose money. And this is especially true right now in deep tech, especially in AIs and all the Gen AIs and big data, all kind of stuff, right? So it's for sure a way to lose money, right? So, but it's also not a way to, monetize that momentum, right? So we obviously try to monetize that momentum of AIs and stuff, but chasing the hype is for sure the way to lose money, right? So, and obviously figure out a way to actually make a profitable business, right? So most deep tech company in the world, in the country right now, does not have a sustainable business, right? They have a cool tech, but no business, right? So that's something, I constantly worry about is most of the company out there, they have cool tech, but no business, which honestly, that's not the way to run a business, right? So, and just the list can go on, but that's the few thing to get started.
But market supports it though. You don't have to have revenue. You just have to have a good story, and you have to have the right founders attached to it, and that builds the story, and it becomes the hype. And so I guess no one has the answer to it. But at the end of the day, that's also why we're trying to tap into you panelists' brain of help us. You know, you are the area expertise. We are looking at it from the outside, and I'm going, wow, look at all these companies going up high and high and higher and high multiple, and they're saying it's only going to get better. Because I actually read Eric Schmidt, who was the AI the Google ex-CEO. He says AI is not overhyped, and he said that last month. So if it's not overhyped, everybody expect it to go higher. But we're also in that era where this could be the wild, wild west. Look at the internet era. The ones that started are the ones that left behind. AOL is gone, right? So how do we go through all that and figure out, okay, at least this one's sensible. Actually, we won't go there. Let's finish the first question.
Yes, I'll answer that question, and I'll answer the question that he answered as well. So how do you make money in AI? The way, and this is my opinion, I do believe that AI is not overhyped in the general sense of the word, but specific companies are, and it's hard to tell one from the other. So the way we approach investing, and we invest typically larger amounts than venture or angel. We invest in things like data centers, things that are always needed no matter what. There's a lot of work to do on that front. There's real estate. There's the pipes that take that fiber optics, for example. There's a ton of work that has to do there. It's obviously not core tech. My background is I'm an engineer and data scientist. But as I looked into the space on how do you exactly make money in AI, I can't tell the good companies from the bad yet, but I know that everybody needs infrastructure. So we're spending a lot of time in infrastructure, in funding infrastructure that has outsized volumes. This could be a real estate deal. It sounds like it, but it has 20x return in 3 years. Talk to me about it later if you like, but it's quite interesting, this crazy numbers there. On the flip side, on the question of what to look out for, I would say policy is an important aspect, regulations and such. And there's this notion that some of you may have heard is called sovereign tech, which is I own ownership of my data, not Facebook, not Google or whatever. And that is gaining some momentum. I'm not sure where it'll go. But the reality is that at some point government regulation will come in, and it'll be hard to monetize data in the traditional sense that Axiom or Experian and those folks did for a long time. So my take on it is that keep an eye out for companies that are focusing on data as the asset. I think you also mentioned that data is not the asset and from that standpoint. But reality is that you really have to look at the combination of first-party data as well as the application layer on top of the data science that goes behind it.
The next question I have, and I share this story with some of my peer, because I'm the president of TCA OC, and so we are in Orange County, and so we are a lot of med life science deal, and so that's what we invest in primarily. But if you remember, we are called Tech Coast Angel. So I am like, we want to do tech. So what I did was I followed the hacker house, and I flew to San Francisco, and I start grabbing and putting all these founders of the AI deal, and I get on Zoom call with them because I am like, these are the hot deal. They just come out of their the hacker house. And so on the Zoom call, I bring in my executive director, I bring in my VP, and we're trying to understand what they're doing, and they are also trying to understand what we're doing. But here's the catch. It's not they're trying to get my money, it's they are trying to interview to decide who they will take the money from. So that's AI. So here's my question. How do we find the deal? Because I failed.
So like I said earlier, I'm not an angel. So I've spent a lot of time building pipelines of deal flows from universities, MIT, Stanford, Harvard, etc., Berkeley, UCLA as well. And also through people who work at the big tech companies. They usually are the leading indicator of a startup being created. These are just very tested things you can always, figure your way out. But we also have relationships with VCs, with other angel groups and such. Just establish pipelines of communication ahead of time, so you're not waiting for the hot deal. It's like you get a steady flow, and then you evaluate how to say yes or no, based not on the hype, because there's a lot of people make decisions on what is somebody else doing, right? Just evaluate it based on your own criteria and see if it's a good fit or not for your thesis, and look at your portfolio as a whole. I also, because of the nature of the work I do, which is larger size deals, I work with attorneys, CPAs, auditors and such, wealth advisors who are looking to exit or looking to do whatever. I'm an investment banker now. So that's the source of my deal flow. And through that, I also get some early stage deal flow as well. So for whoever's interested, I can send out maybe a newsletter or something like that to give you guys access to some of my deal flow. I don't know how to do. Maybe I'll talk to you about that, on exactly how to do that. But I got too much to handle.
Yeah, I'm not gonna lie. This is a problem for angel group. I know. I'm talking to a bunch of angel group, but getting deal flow for angel group is almost impossible nowadays, right? There's no good solutions, to be honest, right? It is a very competitive market out there. Even for us, we have to fight for deals every day, and this is literally my day job, right? I have to go fight for deals every day, and we have to prove value to entrepreneurs, right? So, and for every fund right now, like our size or bigger size, goes to the earlier stage. So there's really no room for angels for most deals, right? Just to be completely honest, right? So I'm just a brutally honest person, right? So there's no room in most deals for angels, right? That's just the reality. But that doesn't mean there's no opportunity to invest at all, right? So for most of the cases, I would say angels has to have a special focus on a very special niche sector to win deals. Right. If you're just an angel investor who will say, okay, I'm just going to invest in every single deal I saw that I think is good, guarantee you won't be able to see any good deals, right? So the good angels, we work with a lot of different angel investors. The good angels are all senior entrepreneurs or senior executives at some company, and they only invest in that particular sector. Like we know a lot of angel investors that are running a robotic company, and they only invest in robotic companies, right? Or AI entrepreneur, founder of Perplexity, we know them. They, for example, only invest in AI deals, right? So you have to have a verticalized focus in order to win deals and source deals. If you just go with a traditional sense, like 20 years ago, I'm just gonna open up a portal and let people apply for it, nobody gonna apply for it, right? That's just the reality, right? So you have to have a very strategic focus in one vertical. That's the only way you can win deals, right? So, and for us as institutional investors, even for us, we need to have a focus now, right? Because everybody is trying to compete deals, right? If I just say I'm investing everything B2B SaaS, that's literally 90% of the deals on the market, you can never win a deal, right? So, and honestly, for the hot AI, Gen AI deals, no matter what, you're gonna have this problem, right? So I think the real solution is you just have to really invest in deals that are underappreciated, right? The hot deal doesn't mean it's always a good deal in early stage, right? So we've known deals that raise hundreds of $1 million in seed round and still dies in 2 years, right? And we also know companies that couldn't raise the seed round and end up raising millions of dollars. Actually, Cola Bio, one of our portfolio company, they struggled to raise the seed round. We were one of the first investor, and then they raised more than $60 million right after that, right? So the good company doesn't always mean a hot company, right? So you just have to really think through what's really your strategic focus in one sector, right? So, but yeah, I mean, another way to do it is honestly go out and talk to people more, right? So, so much of my job is to network with different founders and different senior people. You have to spend time networking with people and networking with the right people, right? So if you want to source good deals, you have to talk to founders, a lot of founders, right? So That's the only way. There's no other ways, honestly. It's a tough market out there. So it's still seller market. It's still not a buyer market, even though we think it's a buyer market. It's still pretty much a seller market. I'm personally also an angel investor aside from my day job. I probably made already like close to 30 or maybe 40 investments, personally, not aside from my day job. The only way you can get, one of the way you can get good deal flows is to constantly start investing, right? Because I talked to a lot of different friends, angels, they just don't invest. I mean, they're angel investors, but they made like one investment, two investment a year, right? So it's just not going to work because you have to build your reputation in the community. Right? If you're never write any significant check as an angel investor, like why would people want to talk to you guys, right? It just doesn't make sense, right? So as individual angel investor, build up the track record is extremely important. And you're going to lose some money, honestly, because it's a high risk investment. You're going to 80% of it, you're going to lose that money, right? But it's a power law game. But like so much of a pitfall for angel investor is they don't invest. That's just literally the problem for being an angel investor, especially in Southern California. Like if I go to Bay Area almost every week, Bay Area angels, they write a lot of checks, right? So they are very active. Every angel investor write a few checks every month. Maybe some roll like 10, 15 checks a year or even a month, right? So it's really active there. But over here, once every month, once every quarter, once every year sometimes, right? So like you're just not gonna have the build up the network you needed, right? So you have to start investing, you have to spend that much money, right? So that's the thing too. In order to get deal flow, you have to start investing first. The deal is not gonna just come over to you just by like default, right? So, right.
Okay, so now I know where my deal flow is coming from this guy. Okay, so the next question is, I got the deal flow from you guys. I need to do due diligence. And it's a chicken and egg thing. You say I need to invest a lot to get a lot of deal, but I can't invest a lot unless I really know a lot. And so how do I, or as a group in the angel level, how do we equip ourselves and how do you do the due diligence? Like you come in, you have it's very popular. Everybody is using CMR, customer service, digital health. There's certain application that's really hot right now. But how do you do due diligence on that? How do you validate the tech?
So prior to my investment banking and investment background, I spent 30 years running companies. And in the course of doing that, I established relationships with hundreds, if not thousands of executives and such. So like you, I rely a lot on them. And I have, so there's like, it's like tiered, right? So there's probably thousands of people who are quote unquote on call to, hey, can you check this out? And somebody else might be, maybe next tier up is people who work at VCs, like, an associate or somebody like that whose day job it is to evaluate methodically. So I have a few hundred people like that who participate in this. So it's like it's a community aspect where you share the rewards as well. Like they're not doing it for free. I'll give them advisor shares or portion of the carry or something like that. And that's the way that they can get involved. And what I get out of it is expertise. There's no way that even if I have 50 people, that they'll be able to match the expertise of everything that's being built out there. And so I rely on networks, off networks, and just sharing the wealth, which is, in my case, it is carry or equity or cash or something like that. And that way, you're not asking somebody for a favor; they're getting something out of it.
Yeah, I mean, just echo on all the other knowledges. So for us as an institutional fund, we do a lot of diligence works internally, but we also have third-party diligence services that doing technical diligence for us. But that's also, we also build a deep network within the sectors we like to invest in. Like, for example, in synthetic biology, we spend a lot of time on. We pretty much know all the top researchers in the world that can actually validate technology for us, right? But that's where having a focus is helpful and important, because that's the only way you can know the people you can talk to, right? So, and obviously, we have a lot of different third party we can tap into and do just market research and all that kind of stuff. And we always do, internally do our reference call ourselves. We do, a customer reference, all kind of stuff, right? There's obviously a list of stuff we do as an institutional fund. Although for angel investing, again, I don't know the topic as angel investing, I would suggest do not do due diligence. Like, do not do any diligence. I mean, this is controversial, but diligence is overrated for angel investing. Like it's useless. I mean, not even joking. It's just a waste of time and effort. You should not do diligence at angel investing. You should only invest in any company if you trust the founder, not trust the tech or business. That's my philosophy of angel investing. And honestly, I made more money investing in people I trust than the investing. I just kind of like doing a bunch of diligence on angel investing, earlier stage, right? So I did a bunch of diligence, did all that work, read a bunch of market report, use the Perplexity to do the research. It never worked, honestly, right? Like it's at early stage, it doesn't matter. Customer traction doesn't matter. The product doesn't matter. Every company will pivot. You will end up investing in a completely different company in 2 years, right? So it just doesn't really matter, right? It's honestly, it's a waste of time for angels to invest and do diligence. I mean, honestly, that's the truth. And if you talk to any serious angel investor in Bay Area, Eric Schmidt, he has the fund, but he's also a good angel investor, Peter Thiel, they will tell you, we don't do diligence when I write angel check. Like I like the founder, I like the business, I write a check. It's honestly a waste of time to think about diligence for angel investing. Like not a joke, for real. Right? It's like what you're gonna do diligence on though. Like they have nothing. So
I agree with him. Probably not to the level, not to the extent that he's talking about. But one thing I will say that you can do other than liking the founder is to see how transparent they are. Like, are they able to open up about issues in the company that may occur, that are inevitably going to occur down the road? So the transparency piece is an important angle that you can assess as an angel investor in a meeting or two. Like, did they say that they're going to send something and did they actually send it? Like, are they being defensive about the questions that you're asking about, or are they like they understand it and they have a good like, let's brainstorm this through? So people who are transparent generally make good founder CEOs, early stage CEOs, in my opinion. I've also angel invested for about 10 years now, about around the same number of companies that he has. So yeah, that's I would say an important thing that you can do. There's a question there. How do you evaluate a non-technical founder as a deep tech founder? If the value that you're creating to the buyer of your product or service is fundamentally technical in nature, then you should pair up with somebody who is an expert in that area. And if let's say it's a good pairing between go-to-market, let's say you're the go-to-market and operations and the other person is the technical side. Well, in that case, you have to learn how to talk the talk, the things that your buyers will care about. Forget about the investors and angels and whatever. They don't matter. What matters is your relationship with your future customer. And how will they treat you, the pair of you, right? You and your technical co-founder. It's really important to establish that as early as possible, even if you're thinking of starting a deep tech company today.
I'm very against non-technical founders starting a deep tech company. It's just impossible, right? I mean, it depends. If you want to do a ChatGPT wrapper, go ahead, you can do it. But if you want to start a nuclear fusion company, I don't know how. I want to start a nuclear fusion company. How can I do it without like a PhD in nuclear physics, for example, right? So, but I'm also very against with the only technical founder, right? So you always need a little bit both, right? So, I mean, we have too many horror stories like Theranos and all that kind of stuff, right? So it's a tricky thing, but like overall, I think in particular in deep tech, you do need technical founders and you do need very good technical founders, in my opinion. And you typically need some sort of like peer review research to really back your claim, right? So versus selling a snake oil, which to be honest, so many of them are out there, right? So I'm against it, but again, like I've also seen companies that essentially a non-technical founder, but very legit, like a senior executive start a company and they hired a bunch of people work around him, right? So it could work. It just personally, I don't really like it, but it's not saying it will never work, right? So
back to the due diligence, I agree and I disagree. I kind of agree not have to do due diligence in a way because I love telling the story. I invited a friend to go to a forum that we hosted. She was an ex-banker financier. She sat through a whole day of a presentation. At the next day, she said, I gave one of the founder a check And I say, excuse me, you're supposed to do due diligence. She says, no, I like the founder, I gave him a check. And so 2 years later, she had an exit. And so she's 100%. But I think from us, Angel, that does do due diligence regularly, I like to think that's our security blanket. It's hard to like blindfold and jump off the cliff. That's what it feels like without due diligence. I would think that's what most of us would agree. So we're still gonna like maybe dip into it a little bit. So the next question is, now that we're kind of doing due diligence or skipping it and we like it, okay, we like the founder, how do you assess valuation? It's flying high, everybody jumping in with the same hot deal. Do you just go with the flow and just valuation doesn't count in this era as far as AI and deep tech goes? Is that how it is?
Again, controversial thought. I'm just a controversial, sorry, not trying to be deliberately doing this, but yes, go with the flow. Valuation kind of doesn't matter for angel investing, even for VC investing, right? Because people don't talk about this enough. I mean, if you go to any like website, you don't read this, but I mean, you probably read about this, but early stage investing, venture investing is a Powerball game, right? It's not about consistently making small wins. It's about having the big wins. It's not a real estate investing. It's not a private equity. It's about power law. It's about winning big, right? So in the typical early stage, at the angel stage, even at the Series A, the valuation typically doesn't matter too much. Obviously for us, we do carefully look at it when we lead a deal, we price it correctly, all that. But as an angel investor, most of the time, the price is reasonable already. It's already priced reasonable to some degree, right? So if you think it's too crazy, don't do it. But honestly, most of the time, earlier stage, it's very binary. It either become a huge company or it become a zero, right? So at that time, chasing that 20% discount, 30% discount kind of doesn't really matter. If you just from the whole big picture, if you do the math, it doesn't matter. Because, asking for 20% discount for a zero company, this is still zero, right? So any number times zero is still zero, right? And if you own very tiny piece of Google, it's still a very huge amount of money, right? So chase the momentum is the right thing in venture, honestly. People don't, that's the thing, it's very counterintuitive, right? You don't want to think like, I don't care about valuation, but
I tend to think about valuation as not the most critical piece, but an important piece in angel. It's not, in my opinion, it's not like it doesn't matter at all. It does matter for the reason that gentleman described. You don't want to get crushed. You're going to get crushed regardless, but you don't want to get crushed a ton more than you absolutely have to. If you don't have bargaining power, it is what it is. In that case, band up with other angels who are putting in small checks, and then maybe you can have a lead angel investor or whatever it is. You can find your way through that, but I would recommend not just giving it up and at least have a discussion about it. Like, why do you think it's valued at $80 million when nothing's absolutely done? So anyway, that's my take.
Okay, now we exited. Do you have any, all the company would talk about their exit. Have you experienced or seen any really good exit since it's still kind of early stage?
For us, we do have a few exits that are good for us, but it's a private acquisition by public company or secondary sales. We sold a lot of secondaries on the market, on top of the market. Valuation is pretty crazy, and we think we already made enough money, so we're very careful about secondary sales. So we've been managing liquidity for our particular fund very well. Although that might not be an option for angel investors, the typical block is too small to do secondary sales. But I guess broadly speaking, in deep tech, there are very good exits happen in the last few years, in particular in AI. For example, Mosaic ML sold to Databricks for about $2 billion, and Hugging Face just bought a few other business, right? So, and Salesforce bought a lot of different business, right? So I would say there's a lot of exit happening, but mostly on the M&A side by bigger company. On the public side, it's very much a depressing world, right? So even the company goes through the IPO or SPAC, pretty much just all died, right? So, but there are very good exit happened in M&A space.
There's a reason I asked that question. So if you experience exit, and we're seeing a lot of exits around, what do you perceive is the variable or the denominator or the parameter that exists that allow or make those company have an exit? Is it the founder? Is it the technology? I like to pick your thought on that.
Use as Mosaic ML as example, it's purely the founder and technology, right? Because companies like Databricks or even Salesforce, they do a lot of acquisition as defense type of acquisition. It's particularly true right now in this age of generative AI, right? So company buys a lot of the best teams out there, right? So you can think about this as a glorified acqui-hire in the sense of they have best team in, for example, edge computing, and then Databricks bought the whole team for $2 billion, right? So a lot of the acquisition in deep tech will be around stuff like that, right? Around acquisition of the team, the talent, the technology, underlying technology. Obviously, that will be, in my opinion, will be 80 to 90% of the companies sold in this space, right? For now. But eventually, it's going to turn into a business game where you have to have real revenues and real business, right? But we're not there yet, to be completely honest, right? So how many companies in AI that has decent amount of revenue right now, right? It's not many. OpenAI, Anthropic, or something like that, right? So in the short term, we'll still be very much tech-driven, talent-driven, and founder-driven.
So this is, obviously LLMs have changed the world in a lot of ways, but if you go back a little bit further, for deep tech companies, it is truly how it's all about M&A. It's not about public markets. And you gotta, from an exit standpoint, you as an angel investor should start feeding in connections that you may already have to potential strategic buyers down the road. Those things are critical because you gotta maintain and develop those relationships over time, because it is a matter of who you know at the end of the day to be able to shape your roadmap as well as drive the right conversations at the right valuations when you do exit. So I think it is something that you can control. As far as the product in tech, I couldn't agree more. It's just really it comes down to the product in tech, less so about the distribution side. Let's talk about defense, for example, right? In defense technology, like there's not that many companies out. I mean, people who can buy defense technology other than a few countries around the world. If you think about semiconductors, it's pretty crowded. Everybody wants to get acquired by Intel, NVIDIA, AMD, and such. So it just depends on what vertical you're in. You got to pick the vertical, of course, that you are knowledgeable about, and figure out what you want to do as an angel investor, how you can influence that aspect of it. And think of the exit, your exit strategy, your own personal money, as well as when you the company should exit. Which are not the same thing, of course, when you put in the check, right? So this is the transparency of the founder, you like the founder, and how can I get my money back?
Okay, so we're going to open to Q&A.
What are some immediate red flags for a pitch deck that claims to have AI?
So for me, if it cannot be a thin wrapper around some chat GPT-ish thing, that is... I would not call that deep tech at all. That is just, that doesn't count. So the question is, how do you detect that red flag? That was your question. I would ask technical questions around how is it built, until you get a response where they say, I don't know, or you get a satisfactory answer. And if it's I don't know, then is it because they don't know because the technical founder is not in the room, or because they just don't know because it's somebody else's technology? But if it's, let's pick another example like semiconductor or something, in that case, you really have to understand the background of the person who's talking to you. It is a very deep technical, world out there in terms of, for semiconductors, nuclear fusion. There's no BSing there. You got to know your stuff.
Actually, how would you suggest doing due diligence?
Your question is, how deep should you go in due diligence for the deep tech aspect of things? We touched upon this a little bit before. My perspective is it's usually the founders are more qualified than I am in that particular area. That's why they're starting a company in that area, and I'm not. And so there's a level of almost respect that I have for them. So what I do is, in that case, I rely on my team, the one I told you about, of the hundreds of people who may in fact be world-class people. In some cases, happened that I had the advisor of this person when this person got their PhD, and they know about the space in a pretty fundamental way. So you just have to, it's obviously depending on your network, but I invest in multiple domains. I am a generalist. I don't have a single lane, but that's why I develop those relationships across multiple sectors, not just deep tech, but other areas as well.
I can just maybe add, I agree, but also just, again, on the diligence piece, I'm not sure if you can actually look at the code and just doing really that type of level of diligence, right? So at some level, you have to find the network people to help you validate the founder, not the tech. Again, if you talk to any other VC or angel investor, they will tell you team is the number one. If you want to do diligence on the team, not the tech, not the product. It just, you can validate the tech by doing diligence on the team as well, right? So if they are a great team, great researchers in AI, sure, they might have some good one. If they are just kind of faking it, and then your advisor easily gets some loopholes on their conversation, hey, this guy probably not probably not the real tech, right? So do more diligence on the team, not the tech. Right? Like reading the code base doesn't help. For us, in particularly, we care about obviously competitive landscape very, very much. And for us, one of the way we do diligence is around customer reference, because we are very much deep in customer reference when we do diligence. We do average 3 to 5 reference costs for each of the investment we led. And during the process, we always ask the potential customers or customers, like, why do you choose this guy, and how many other competitors you actually talk to, right? So a lot of time, the customers know a lot more than us, right? So their customer talk to 3 or 4 competitive already, right? They'll tell us, company A is the best because of some certain things, right? So, because at the end of the day, you have to sell to a customer, right? So we do a lot of the competitive analysis based on customer reference. I would say, it's very important for us. But aside from that, we obviously, again, we do all the traditional competitive analysis and landscape research, right? So, we can obviously do a lot of research on that. But end of the day, the buyers is the one who ultimately made the purchase decisions, right? You have to really doing work around that, right? So, but again, like for angel investor, stage at angel investing, a lot of time they have no customer, right? So like that's just not going to happen. You cannot have a customer reference call. They have no customer, right? So,
since we're talking about deep tech, how do you guys think about patents and IP and IP protection?
Very loud, but I think it depends. For us, for some type of company, we really care about IP and patent. For some other type of company, we really don't care. Typically, for software-related stuff, we don't really care about IPs or anything because you can't really do it. But for some of the more physical science, material science, or some of the more system engineering work, we definitely care about IP a lot. And for us, it's not only like we care about IP and also, but we also care about freedom to operate for the future, a potential lawsuit, right? Because that happened very often in deep tech that people sue each other. I don't know, the lawyers want to make some money, I guess. So this is very common. So we want to make sure at least the company has freedom to operate, that can actually operate in this space. It's very clean IP space, all that kind of stuff, right? So we do care for certain companies, and we don't really care, for example, for AI, nobody has IP, quote unquote, right? So everybody kind of uses, their own secret sauce, right? Like trading secret is more important, right? So, but yeah, it's a good question.
Yeah, more or less what he said. Trade secrets are sometimes more valuable than filing patents, and freedom to operate is the name of the game. It's really, you don't, a lot of people file patents to feel good about it and think that that's valuable down the road from a valuation standpoint. My suggestion is don't worry too much about that. Just focus on making profit, because that never goes out of fashion.
Okay, we're going to wrap up. And what I like each panelist to do is give our audience one key takeaway for the day. By the way, Yipeng, angels don't do due diligence. It's not it, okay?
Use as much collective bargaining power as you can as angels, especially if you know other people are going to considering putting in money here, so that you can ask those questions about valuation, where the digital will go. Those things are important.
Takeaway, our number one suggestion for me will be, let's start writing checks to the whole so-called ecosystem, because we need more angels to write more active checks, right? So, and let's just write more checks for this year. Honestly, that's just my suggestion, and it will be great for the community as well. Write more checks.
Thanks everyone for listening. Really appreciate it. Catch us on the next one. Subscribe to our Substack. Looking forward to it.